Good morning. Yeah. All right. I see some of us still need some coffee. Good morning. I'm Shawn Wooden, partner and chief public pension strategist for Apollo and former treasurer of Connecticut. And this gentleman will tell you what that is. And glad to have you join us for this panel on uncovering alpha in volatile markets. Treasurer Russell?
Sure. So, hi, good morning. My name is Erick Russell. I'm the state treasurer in Connecticut, just kicking off my third year in this role. My core responsibilities is that I serve as principal fiduciary for our state's nearly $60 billion in pension assets, oversee the general fiscal health of the state, all of our cash and debt, and then have a really unique opportunity, I think, to weigh in on broader fiscal policy and economic policy in Connecticut.
Hey, good morning. I'm Andrew Palmer. I'm the Chief Investment Officer for the Maryland State Retirement Agency. It's a $70 billion defined benefit plan and some other investment assets that we manage for the state of Maryland, 400,000 participants there. My role as CIO is to run the investment division, and one of the good things about the governance there is that the investment division has the authority to hire and fire managers, so all the decision resides with our team.
Hi, I'm Rich Nuzum. I'm the Executive Director for Investments at Mercer and Global Chief Investment Strategist. We advise, as an investment consultant, several thousand clients with aggregate assets exceeding $17 trillion. And then as an outsourced Chief Investment Officer, we directly pick the managers for more than $600 billion in AUM. I was our Chief Investment Officer, 2 separate stints, totaling 8 years. I led the business for 5 years globally. But the last 2 years, I've had the fun job of being back in a client-facing role, working with our large clients on mainly asset allocation and governance, and then also innovation capture, which I'm sure we'll come on to.
Thank you. So thank you all for joining us today. I'd like to set the stage before diving into some questions and discussion for what's facing public pension plans. Post-GFC, public pension plans have not recovered from the losses, and the unfunded liabilities keep rising, right? So at the GFC, it was about 93% funded. Now we're looking at about 81% funded levels, even with the recent uptick in those levels. Estimates are we're looking at a $1.3 trillion gap between assets and liabilities. And that trend is projected to continue. Demographic headwinds with the aging of America, or the silver tsunami, is increasing, and that trend is continuing. People are living longer, which is a good thing, but it does present challenges, and the dependency ratio, or the amount of those in the workforce currently relative to those who are aged out or too young, that's increasing. And so these are some real headwinds. And then when you look at the public equity markets, a place where we've relied upon for diversity, for alpha, for a number of things, increasingly challenged. You know, even recent news kind of underscores this point. You have the Magnificent Seven dominating so much of the public market, so you have concentration risk. You have traditional active management now has largely moved to passive management, so you're getting more beta out of that part of the portfolio. And you have the challenges of looking at interest rates higher for longer, as well as concerns about inflation. And so just want to set the stage of what we're looking at, and we're going to talk about like searching for alpha, but in the context, like we've discussed, in the context of public plans, you can't talk about that without kind of looking at the total portfolio and the defensive and risk protections as well. So with that backdrop, Treasurer, I'd like to start with you. So given that, what are you seeing and how are you positioning Connecticut's portfolio? If there are 2 or 3 things that you can touch upon, or they limited our time, so let's 2 things that if you could touch upon that you're doing in the face of kind of these headwinds and what we're looking at.
Sure. I'll touch on one piece, I think, from the pension plan side. And many of the headwinds that you mentioned Connecticut has felt really hard, right? As you talk about unfunded liability, we were at about 30% funded for many years. We went about 70 years without properly funding our pensions. It really wasn't until 2011 that the state really started making its required contributions on an annual basis. And just from a policy perspective, what we have ultimately done in Connecticut is put a legislation in place that really guides all of our budgeting practices, but also paying down of long-term debt. And so part of those fiscal guardrails, again, budgeting how much revenue we can appropriate. One of the big pieces for Connecticut is that we've put a volatility cap in place, which is essentially, in Connecticut, we have a lot of volatile revenue, a lot of capital gains coming in. And what we did historically is that we would project what those volatile revenues may be, and we were very rosy about those anticipated revenues, and we would budget off of them, and would then end up with billion or $2 billion gaps in our budget. We put a cap that sets an amount of that revenue that we can count on, and then anything over that cap gets held in that fund and is used to pay down long-term debt. And over the last several years, we've paid an additional over $8.5 billion of additional contributions into our pension fund to really catch up. But we've also done a lot of work, I think, in thinking about asset allocation, which is we've made some significant shifts to. We've been underweight for a long time in private markets, and so part of our plan is moving more of our portfolio methodically over to alternatives.
Thank you. Andy?
Great. So yeah, we faced many of the same issues that Erick faces. We had a wider range. We went from 100% funded to 64% funded, and now we're in the mid-70s. So we've had a pretty wide ride in terms of the funded status. Contributions have been great from that perspective. We switched to a more defensive portfolio. So one of our primary things is our first line of defense to maintain the value of the assets is the diversification we build into the portfolio, because we're paying out. Every year we pay out net benefits. We get contributions, but they don't cover the benefits we pay out. So we're writing checks every month out of the investment portfolio to pay benefits. And so if you have any kind of drawdown, that really impacts the ability, how much more you have to make on the way back up. So we have a structure that is built to handle that. So we're evaluating that now. We'll talk about that in a minute. But from a structural perspective, that's one thing we're doing. The other is we're really thinking about what's not priced into the market. So we do a lot of scenario analysis that includes things like climate scenarios, because we don't really know what the future is going to look like. We want to have a portfolio that will perform reasonably well in most markets.
Thank you. Now, Rich, Mercer, you advise clients throughout the globe. What are the challenges your clients that you're seeing at this point?
It's really, I think the main one's around innovation capture. So we start with, if you're US dollar based, a 10-year treasury at about 4.5, a TIPS at 2.1, we can lock in those yields risk-free. But if you look at, for example, at US public funds, the average expected rate of return is about 6.9. So, we can't just do risk-free, we have to do something more. And there's much greater opportunities in private credit, infrastructure, real estate, both the debt part of infrastructure and real estate and the equity tranches, and then continued opportunities in private equity. You mentioned at the start the concentration of the public markets in the Mag 7, it's above 30%, and that's been a danger sign historically. In the US, with the Nifty 50, with the dot-com bubble, we had market concentration lower than that, and it didn't end well. That also hasn't ended well in Canada, the Nordics, other places where that kind of market concentration has developed. And those are great companies, but any digital business models subject to disruption from below, and we might have seen just a glimmer of that in the last couple of days. So clients are focused on diversification to capture opportunities, but that starting point of high real and nominal yields, that's very different from what we've had in any time period in the last 15 years since the GFC. We've got pretty good yields out there to build on. So you can lock in a well-diversified portfolio that has a very high probability of getting, whether it's 6.9 for US public funds, or more typically 8% for global sovereign wealth funds, or inflation +4, inflation +5 for an endowment, a foundation, a family office. Those objectives are a lot more realistic now, given innovation in the capital markets and our starting point of high real and nominal yields.
Now, I've been sounding the alarm bells about our public equity markets, I feel like, for the past 12 months. But I read an interesting article this morning that talks about the Dow Jones, actually, the index increase. So they had an uptick despite what took place in the market yesterday, and maybe that bodes well to say we might be okay if the Magnificent Seven blows up, right? I'm being extreme about it, but I'm just curious about your thinking.
So it's early days, and I'll probably be proven wrong. But my take on the challenge from DeepSeek is it's a challenge to the pricing power of some of the Magnificent Seven. But for the rest of the economy, if you're trying to play AI and digital and get that in your business, having more competition, having another model available that's cheaper, that uses less energy, these are good things for the overall economy. I was just at the World Economic Forum last week and in Davos, and compared to a year ago it was all about the dangers of AI, misinformation, disinformation, and global election cycle, particularly for the U.S. elections. How do we regulate AI? Are we going to end our civilization through Skynet and Terminator scenarios? All that, but serious conversation about that stuff. This year it was about optimism and fear of missing out, and huge pressure on the European governments from European C-suites to regulate less. But you think about the three big transitions we're going through: the demographic transition, which you framed, the digital transition, the energy transition, which Andy touched on. Do we have this right or not? How big is digital? Are we investing too much in it, too little? So I think having another model come on the table that's cheaper and uses less energy, if that proves out to be true, that's unambiguously good for the rest of the economy, even if it's bad for one or more of the existing Mag 7 stocks. And like you, I've been sounding the alarm about the concentration of Mag 7 for more than 2 years. My clients are sick of hearing about it. I'm like the clock that stopped, and sooner or later I'll be right. But diversification has paid off historically, and digital can do well even if individual stocks within the digital don't do as well.
Great. Now, Andy, I want to take a deeper dive into strategic asset allocation. And how are you thinking about this? How are you preparing for these trends that we're talking about?
Right, so we're actually going right now through an asset liability study. Do it every 5 years, and so this is a refresh on that. And the way we're thinking about it, working with the board, is the experience the board has had, and one of the elements that we have as public plan boards, maybe not so much Connecticut, is that there's a lot of turnover in the board members. So the people who had put the asset allocation in place 5 years ago, they're not around. So maybe that's a good thing, maybe it's a bad thing, but they don't own it. So they really did look at it with fresh eyes. And the diversification that we put in the portfolio to protect us against downside, which worked very well in 2020, 21, 22, it has overall kept us from returning as much as other plans and as much as we might have. So that's something we're addressing. They're looking to add more risk into the portfolio. We've got a very high Sharpe ratio and very good implementation, but overall we're not earning enough in their minds to meet our objectives long term. So we're looking at adding risk. Some of the ways we're doing that is thinking about, even 5 years ago, our implementation, because we had a low interest rate environment, was how do we get there and how do we build in some risk protection. So we did sort of a barbell approach where we added more risky. We went further out on the risk spectrum on the equity side. So we added emerging market stocks and private equity. And on the other side, we added more diversifiers in terms of long government bonds and things like that. And that really hasn't been as successful as we would have hoped in this last 5 years because bond rates went up, and the only thing that went up was U.S. stocks. So that hasn't worked. And so we're looking at either unwinding that barbell and putting more in the middle and taking more net risk overall, but more things like private credit and infrastructure, or do we continue to push out on the wings and add more private equity, more private public equity, and add more diversifiers on the other side. One thing I think we're definitely going to do is We've had a standalone position of about 6% now in absolute return, which had a goal of cash plus 5, which has been really hard to meet. And so it's been sort of we've been meeting our return risk and correlation and beta targets there, but it's been hard to generate the returns. But it's a great alpha source, so we're probably going to turn most of that into a portable alpha strategy and then take that that spot in the portfolio and allocate it toward one of the more traditional betas.
Thank you. And could I ask, what's your assumed rate of return?
6.8. It's dropped from basically 7.8 to 6.8 in the 10 years I've been here.
Got it. Okay. And Treasurer Russell, so I know Connecticut's 6.9.
Yep.
Assumed rate of return. What do you see in the next 12 months from a strategic asset allocation perspective?
Sure. So back in 2022, under Treasurer Wooden's leadership, we went through a strategic asset allocation study and actually locked in a new asset allocation. As I mentioned, a lot of that shift was moving assets over to private markets. And so we increased allocations, private credit from 5% to 10%, private equity up to 15%, real assets, same thing, infrastructure and natural resources. So we've been in the process, we've had a 5-year pacing plan that we're methodically deploying capital to those asset classes. You know, it's a good problem to have, but one of the challenges has been that we've been performing well as a fund, and as I mentioned, we've been making these additional contributions, so the plan is growing significantly. So that, you know, the challenge there is actually meeting these targets over that same period of time because, frankly, we've outpaced the projected scenarios that we've run our pacing plans under. And so we actually, we're on target with that 5-year pacing plan to hit our targets in our portfolio for real assets and infrastructure and natural resources by 2027. We actually just decided to extend the pacing plan on private credit and private equity by another year because we were just having these huge spikes. And so just, again, thinking about the diversification more broadly in the portfolio, wanting to also make sure that from a vintage year perspective, we were deploying capital a little bit more steadily. And so, you know, the other positive, I think, from this timing is that we've been net buyers in many ways where a lot of plans have been kind of overweight in private markets and have been selling off, which has allowed us to really be intentional about, you know, how we're deploying capital and really looking for good opportunities from a value perspective.
Thank you. Now, Rich touched upon this notion of innovation. And I'd love for each of you to talk about the tension between kind of what works, what has worked, and what you see for the future, right? And that tension with innovation and how do you get there in terms of moving or altering your plans based upon that, right? Because some might ask, well, this has worked for the last 5 to 10 years, and you want to do something different, right?
I'll start. I think I have 3 T's. The third one's kind of a stretch. So a big part of what drives innovation is having the framework to be able to execute on it. And so what we've been working on is building out the team and strengthening the team's capacity to become investors as opposed to just allocators. They are thinking like investors. So we've spent a lot of money and a lot of time building out the team. We're building out the tools because we think the tools to invest in the economy today are much different than they were before. A lot of the discussion is on basically taking a individual portfolio and making it really big, and then they can add a little bit of private stuff, but you can be reasonably thinking about it the same way. We think the world is moving to more of a separating the beta and the alpha and being really just disciplined on how you build all that. And that takes different tools. It takes derivatives. It takes more bespoke ability to implement. And the last T is a stretch. I came up with toss salad, but basically what we're trying to do is create a ability to look around the corner and think about what's coming. We want to think about what the next part of the economy that is going to be 30% of the S&P 500. It's not going to be the tech guys for 10 years. Maybe it's going to be the climate transition type stuff will be the biggest piece in 10 years. Who knows? Well, we want to think about that and start positioning ourselves for those places in the future. But we have to overcome the sort of asset class restrictions, not restrictions, but the patterns of behavior that most investors have pattern recognition. They see something that there's worked before and they want to do it again. So we re-up a lot for the same private equity firms. They've got a structure, and it's hard to put something new in. So we're working with the board to create an opportunistic piece and enabling the team to come up with ideas and pitch it for capital to put it in that space, and so we can start thinking about what else can we be doing, what's coming next, and how do we position ourselves for that?
Thanks, Andy.
No, go ahead. Okay. Well, I think, so it's a mistake to generalize about public funds or any client segment, but I will. I agree with everything Andy said, but I'd start at a higher level, and one of my mentors told me the soft skills are hard. So getting alignment from the board on what the real objective is, and then every time you get a new board member, walking them through that and checking, are they aligned with that objective or not? Because if you don't have that, you're doing the whole thing on a shifting foundation, on quicksand. And then what's the strategy to achieve that objective, and then how's the implementation working against that strategy? And every meeting, every monthly or quarterly monitoring report is an opportunity to rebuild, reinforce that top to bottom understanding of why do we have the program that we have. And why do I say that? Well, what can go wrong? You get new board members in and they say, well, our programs underperform the S&P 500. How could that happen? We can buy that for free. How could you do that? And those comments actually sound reasonable to vacuum, and you need the rest of the board, the staff, all saying, but ideally that board member, before they even get to the meeting, gets walked through. In the last allocation study, we looked at this, and this is why the investment policy statement looks like that, so that doesn't build momentum. I'll give a different example. We had a Canadian corporate defined benefit plan do a liability-driven investment strategy, and post-GFC, they did very well because they were in long bonds and bond yields dropped. They did very well. They had a couple new board members come in, a change of control, take private transaction, and appointed a really sophisticated hedge fund portfolio manager to their investment committee. First meeting, Canadian interest rates have spiked, the liability-driven investment portfolio is down 40%. And he asked the board, who's going to jail for this? What idiot decided it was okay to invest this portfolio in long bonds? Everybody knows interest rates going to go up. Now, since he said that, interest rates in Canada are actually down. But you know, so in a vacuum, his view makes sense. It made no sense relative to the strategy that the prior board had adopted. And last comment, in my experience as a consultant, you never want to put anything through on a 5-4 vote, because then you get one member changes and you're going to reverse the strategy and not do private credit or not do infrastructure or not do long bonds. It's you know, you want to have more consensus than that if you can possibly get it, and more cohesion in the board, and also have the members who may have had concerns feel listened to, even if that particular decision goes against them. So there's a lot around governance to keep your eye on, so that when we hit crises, one of the clients I'm most proud of that I worked with in my career is Ohio public employees during the global financial crisis. This is all public knowledge, but Ohio got crushed by the GFC because the auto sector stopped producing cars. Ohio's economy is all auto parts. So suddenly no contributions, massive outflows from the government. The portfolio got crushed, and that board of lay trustees with just a couple investment experts doubled down on distressed debt in the middle of the crisis. I was so proud of them for doing that. But that was a credit to the CIO and the staff and everything that their advisors had done, not just Mercer, their other advisors, to build support. We're trying to do X. We have liquidity, we have an opportunity, and we really need this, guys, because we're not going to get any contributions to do something that was tough in the middle of a crisis. So I think that's what you're aiming for, is for your board to be ready to be opportunistic as opposed to reactive and chase future success, not past success.
I agree with much of that, and I think, you know, we're structured a little bit differently in being a principal fiduciary, also being an elected office, and these roles of treasurer are very different from state to state. But I think a lot of my focus has been that on kind of on the macro level, really thinking about how to build confidence and support in what we're doing. As I mentioned, there's been a lot of challenges around recruitment and retention of investment talent. And as an example of this, we had about a 12-year run in Connecticut where we had 9 or 10 different folks in the CIO spot. It's really hard to set long-term investment strategy when that's the approach. The problem is, we ended up changing legislation that really allowed us to be stronger from a recruitment and retention perspective, to be more competitive on salary, obviously not looking to set the market, but to make sure that we can bring the right people in and then hold on to them. And what that's also allowed us to do is really build confidence in what we're doing and to set that long-term strategy, not only internally, but externally with the legislature, with the public in Connecticut. Similarly, we have an investment advisory council that we work closely with, and it's really the oversight body. We bring every manager that we're proposing to make an investment before that body for them to vet those managers. They set our asset allocation. The challenge in Connecticut is due to kind of ethics concerns. We had a statute in place that didn't allow anyone who is actively working in the investment space to actually sit on the investment advisory council, which kind of defeats the purpose, right? And so we changed that legislation. We have some really talented, experienced institutional investors that we've been able to have join the IAC and really add value from that perspective, which again, I think has added a lot of confidence from kind of the public perspective. And I think with that, it's given, my job, the way I view it, is providing insulation for our investment team as we set this strategy, but to make sure that my CIO and the investment team knows that they can go out and be proactive and opportunistic, seeking out these opportunities, and that we'll have the cover that we need to from a political perspective.
Thank you. Now, we've got about 1 minute, and so I'm going to ask each of you, in this context of finding alpha, give me one asset class or theme that you're leaning into or advising your clients to lean into, and why. Rich.
So the throwaway comment is diversification, which has been an easy argument to make in every country I work in except in the US. But the US stock market, the Mag 7, US venture capital, US dollar have all been top performers. So our peer group medians in the US are massive overweight home country, which is also where our funding comes for contributions, whether you're a public fund relying on tax revenue or whether you're a corporation relying on the business cycle. So we're really loaded up on US risk and diversification. Emerging market infrastructure would be like the more responsive answer for what I think you were looking for, Shawn.
Thank you.
I guess a little bit of a twist on it. I would say that I think the world is going to be a lot more volatile going forward, and so there I would be recommending people like build not so much liquidity, but the option to have liquidity into the portfolio so that you can be responsive and not be handcuffed.
And how are you building that?
Right now, we're moving some of our exposures to derivative-based, so that we have, and then we have cash behind those. So that helps us keep the beta, but we also have cash buffer to address any kind of upcoming need.
Treasurer?
Similarly, we've increased our cash position. I think the liquidity piece of that is going to be really important. Other thing I would just say is I think there's going to be a lot of opportunities in kind of these smaller and more mid-sized transactions. And so we really are doing a lot of work paying attention to some of these emerging managers that I think can create more opportunity.
With that, we are out of time. Thank you so much for doing this. Let's give them a round of applause.